Have you ever wondered how often stock market crashes happen? It's a question that might have crossed your mind, especially considering the financial implications that come with it. Understanding the frequency of these events isn't just for economists or Wall Street gurus. It's a crucial piece of knowledge that can illuminate patterns, inform decisions, and perhaps even help us prepare for future downturns. So, let's embark on a journey through time, through the highs and lows of the financial world. Let's dive into the history of the stock market to find the answer. Before we delve into the frequency of crashes, it's important to define what a stock market crash is. In essence, a stock market crash is a sudden, dramatic drop in stock prices across a significant cross-section of the market. This rapid decline can occur over several days or even a single day, leading to substantial losses for investors. It's like a lightning storm that strikes the financial landscape, leaving destruction in its wake. What makes a crash unique is its widespread impact. It's not just a few stocks taking a tumble, but rather a broad and significant portion of the market. This is often due to widespread panic or economic factors that affect the entire market, not just individual sectors or companies. Stock market crashes are significant events that shake investor confidence, disrupt economies, and can even have global implications. Now that we understand what a stock market crash is, we can explore how often they occur. History provides us with several examples of significant stock market crashes. Let's travel back in time, beginning with the Wall Street crash of 1929. This devastating event was triggered by a speculative bubble and led to a decade-long Great Depression, affecting not just the United States but the entire world. The market lost nearly 90% of its value, making it one of the most severe crashes in history. Fast forward to 1987 and we encounter Black Monday. This crash was a result of program trading and portfolio insurance hedges going wrong. In a single day, the market plummeted by more than 20%. This crash, unlike its predecessor, was short-lived and the market recovered within 2 years. The new millennium brought with it the dot-com bubble of the year 2000. The explosion of internet-based companies, fueled by speculative investments, led to a market crash when these companies failed to turn a profit. The Nasdaq Composite, home to many of these tech companies, lost a staggering 78% of its value. The most recent major crash in our timeline is the financial crisis of 2008. This crash was triggered by the collapse of the subprime mortgage market in the United States. The resulting global recession saw the loss of millions of jobs worldwide and a significant drop in global GDP. Each of these crashes had unique triggers: speculative investments, algorithmic trading mishaps, the overvaluation of tech companies, and a failing housing market. However, the common thread tying these events together is the far-reaching impacts they had. Job losses, economic recessions, and even global depressions followed these crashes, underscoring the power of the stock market and its ability to affect not just investors, but everyday people as well. As we can see, stock market crashes have occurred at various times throughout history, each with its own unique causes and impacts. So, how often do these crashes actually happen? Well, the frequency of stock market crashes isn't something etched in stone. There's no set pattern that we can follow to predict when the next big crash will be. However, if we look back at history, we can observe that significant crashes tend to occur every 10 to 20 years. This pattern isn't a rule, but rather a rough observation. The factors that contribute to these crashes are numerous and complex. They include things like economic instability, political turmoil, and unexpected global events. For instance, the Great Depression in the 1930s was triggered by a combination of economic factors, while the 2008 crash was largely due to a crisis in the housing market. Moreover, the rapid advancement of technology and the globalization of markets have made the financial world more interconnected than ever before. This means that a hiccup in one part of the world can have ripple effects that reach far and wide, potentially triggering a market crash. It's also worth noting that smaller market corrections, which are drops of at least 10%, happen more frequently than full-blown crashes. These are often seen as healthy adjustments and are part and parcel of the ebb and flow of the market. While there's no surefire way to predict when the next crash will occur, understanding the frequency of past crashes can provide some insight. Now let's talk about the impact of these crashes. In the short term, stock market crashes often result in panic selling, leading to a steep drop in market prices. This sudden decline can send shockwaves through the economy, affecting businesses and individuals alike. Companies may experience a drop in their value and might have to make tough decisions such as laying off employees or cutting back on investments. In the long term, these crashes can potentially lead to recessions. A recession is a period of economic decline that lasts for at least 6 months. During this time, unemployment rates often rise, businesses struggle, and individuals can lose a significant portion of their wealth. However, it's important to remember that economies are resilient. They have an inherent ability to recover and grow over time. So while the impact of a stock market crash can be severe, it is not permanent. The impact of a stock market crash is far-reaching, affecting not only the stock market but the entire economy. In conclusion, stock market crashes are a part of the economic cycle. They are, in essence, an inevitable occurrence within the financial ecosystem. Their frequency, though inconsistent, has been a recurring phenomenon throughout history. From the South Sea bubble in the early 18th century to the Wall Street crash of the late 1920s, and more recently, the global financial crisis of 2008, the impact of these crashes is profound, affecting not only investors but also economies and societies at large. However, the unpredictability of these occurrences does not mean we are powerless. By understanding the history of these crashes, we can gather valuable insights. We can discern patterns, learn from past mistakes, and make more informed decisions about our financial future. So, while we can't predict when the next crash will occur, we can be better prepared by understanding the past. This knowledge empowers us to navigate the uncertain waters of the stock market with a bit more confidence and foresight.